with none other than Mr. Nilesh Shah, who is the Managing Director of Kotak Mahindra AMC. A gold medalist chartered accountant, he has over 3 decades of experience in the capital market. Welcome to the show, Mr. Shah, and thanks for being a part of the discussion.
Thank you for inviting me over here.
So the wealth management industry in India is still in its nascent stage. So for people who aren't familiar with the concept, what is wealth management and how is it different from asset management?
In asset management, we manage money on behalf of people as per the mandate given. So for example, if Nikhil wants to invest, let's say, in large cap equity, he will give money into a mutual fund scheme which is dedicated towards large cap equity. But the wealth management is taking care of Nikhil's objective. Now, maybe this is the market where you should only be equal weight to equity. And part of that can be in mutual fund, part of that can be in direct stocks, part of that can be in offshore assets. So wealth management is all about taking care of an individual's wealth. Asset management is all about managing assets as per the mandate given by the individual.
So what is that extra part which would, which is not there in asset management, which is there in like maybe taxes or real estate?
Asset management is, as I mentioned, as per the mandate given by an investor. It is a collective investment pool where lots of investors come together. Wealth management is all about individual attention. It's not only managing your mutual fund investment or AIF, but also variety of services like succession planning, record keeping, tax management, and so on and so forth. So I'll say that wealth management is a bigger service to the customer. Asset management is a smaller part of it.
So is wealth management meant only for our millionaires and billionaires? How can we make these services accessible to the middle and lower middle income classes, as well as young people who are just beginning their savings and investment journey?
So essentially, there is no free lunch in the world. There will be more wealth managers who will be happy to serve a billionaire than a retail investor. But look at reverse way. A billionaire has already made money. The retail investor needs the services of wealth manager to make money and become a billionaire. So there is a need at the retail investor level, and there is services at the top end level. But thanks to technology, now there is a fair amount of mixture happening. We have seen many platforms coming up which bring institutional class research to retail investors. They give you services through technology. And at the end of the day, I believe the lower end of the recipient or investors will have more technological solution, and the top end, the HNIs, will have more personalized solution.
What are some of the trends that we are seeing right now, especially in the light of the digital transformation, tech revolution, and now also we have the hype around crypto? So how are portfolios of HNIs changing now?
So traditionally, if we see, most HNIs were invested towards land and real estate, partly gold. Now, slowly and steadily, there is a shift from real assets to financial assets. Even in real estate sector, we have started seeing REIT, InvIT coming out. Against gold, we have seen sovereign gold bonds coming out. And overall allocation towards fixed income, hybrid, and equity is rapidly increasing. Earlier, wealth management and HNI portfolios were more direct. They will go and buy land, they will go and buy real estate, they will go and buy direct stocks. Now it is getting more assisted. They will invest in mutual funds, portfolio management scheme, alternative investment fund. They will take help of professional bankers and wealth managers. So clearly there is a churn happening whereby from direct to professionals, from real assets to financial assets, movement is happening.
And amid all this movement, how important is diversification in your wealth management strategy?
Well, you have been told that don't put all eggs in one basket, and that proverb applies onto the wealth management side. With the benefit of hindsight, we will know that you should be investing in this asset or that asset. But how many people can predict future? Virtually none. In an unpredictable environment, in a volatile environment, what is the best way to survive? The best way is diversification. You put some money in debt, equity, commodity, currency, offshore assets. You try to be overweight cheap markets, cheap asset classes. You try to be underweight expensive asset classes. That combination ensures that year on year, you continue to get real return better than inflation with an acceptable volatility. So clearly, wealth management means diversification.
Typically, for an HNI investor who is aggressive or fairly aggressive, would you recommend like a 60%, 70% in equities, then rest followed by bonds or fixed deposits, then gold and maybe a bit of real estate as well?
So apart from risk profile, you also have to appreciate the investment objective and the time horizon. Now, if you are Virendra Sehwag kind of aggressive batsman, obviously whether it's test match or one day or T20, you are likely to play aggressive. Same way an aggressive investor in a bullish market, bearish market will be seeking higher risk, higher return opportunities. But the same Virendra Sehwag, when he's playing on the 5th day of a match, in a test match, he's unlikely to play like he's playing a T20. He'll be cautious. So you make adjustments to your risk profile depending upon your investment objective and time horizon.
Affluent middle class population is growing in India, and as per the estimates of the World Economic Forum, 80% of our population is expected to be in the middle class segment by 2030, which is up from 50% a couple of years ago. So are we moving towards greater adoption of wealth management services? How do you see this market growing?
Undoubtedly, today there are roughly about 3 crore investors in mutual funds on a unique basis. Someday it's going to become 30 crore. Today's 3 crore investors are getting serviced by wealth managers. Tomorrow's 30 crore investors will require services of wealth managers. But as I mentioned earlier, the top end of the wealth or investors will be serviced in a personalized basis. The bottom end will be serviced by technology. It will be an evaluation of model where there will be Udupi restaurants also and a 5-star restaurant also. You will have a Michelin rated chef also, and you will have a normal chef also.
In the current market environment where there's high inflationary pressure and there are already fears of a global recession, has your strategy changed? Is your focus currently, how much of your focus is currently to hedge against inflation?
So undoubtedly, inflation is a cause of concern. And there are multiple factors which is driving inflation. One, obviously, is the geopolitical reasons. If there was no Russia-Ukraine situation, then certainly inflation would have been much lower than what it is today, especially in energy-related items and food-related items. The second one is also the fiscal and monetary stimulus, especially in G7 countries, which put more money in the pockets of consumers, and hence demand went up. Now, if we see commodity prices have started correcting, wheat prices have moved from about $850 to $1,200. They are now back to $850 in US. Energy prices haven't corrected as much, but as demand comes down, energy prices also will come down. The Russia-Ukraine situation is still unresolved, so it will have material impact on the future trends of inflation going forward. The fiscal and monetary stimulus are now on the withdrawal side. Fed is tightening, they are launching QT. So overall, if I see inflation undoubtedly is high, but it is reaching a peak and it will start coming down because of the drop in commodity prices and withdrawal of fiscal and monetary stimulus. The joker in the pack remains Russia-Ukraine situation. We did hear a research report which talked about oil at $380 in certain extreme scenario. Now, I don't see that's the likely to happen, but you have to keep in mind that something like that can happen with a very, very low probability, but very, very high impact. Now, in this scenario, obviously, you have to manage your portfolio with a view to generate real return. Globally, equities have come down to a level which is comparable to March 2020 pandemic valuation level. So asset classes like gold, equity looks reasonable from a risk return point of view. They will be volatile, no doubt about it, but they can deliver returns if even start supporting the global recovery.
So, Mr. Shah, when you go and meet your clients, and especially the rich investors, do you see what is your understanding of? Are they fearful? Are they greedy? What is the sense of the greed and fear index?
So, India is not a homogeneous society; it's a heterogeneous society. You get all kind of people, but majority of people are today far more confident about India growth story and future than probably ever in the past. This confidence is reflected into SIP flows and equity flows. We are having net sales of about 16,000 crore a month. Earlier, FPI sold about 50,000 crore between Jan to March 2020, and our markets corrected 38%. This time they have sold 5 times more from October 21 to June 22, and markets have corrected about 20%. So clearly, it's not only the bullishness of the investors and confidence of the investors, but also the money which is talking. And this is a fantastic thing. So overall, investor confidence, retail, HNI, India, Bharat, urban, rural, top end of the pyramid, middle end of the pyramid, all seems to be fairly confident on India. As I say in lighter vein, this time investor confidence on India growth story seems to be ahead of fund managers' confidence on India growth story.
So in recent years, we have seen the emergence of wealth tech as well as digital models. So how has this changed your model of functioning?
Well, we have to change as per our customers' requirement. If I don't change, they will always find some other alternative. So even before the pandemic, we were moving towards digital world. Our KYC was becoming digital. Our onboarding of investor was becoming digital. Our investor education was becoming digital. Our servicing was becoming digital. Our query resolution also was becoming digital. Pandemic probably fast-tracked everything. Even our interaction started going digital. Very recently, I had a bank event in physical format. And while after delivering my lecture, I was standing out for recording some bites. Many investors came out and said that, Nilesh bhai, in COVID time, we had heard your webinar. and we invested and we are making a lot of money. Thank you. Now, this was all possible because of the digital medium. If we had to wait for physical event, I think the entire COVID opportunity would have passed and not have been able to talk to our investors. So there is no doubt that right now there is fast track of digital ecosystem and environment in our industry as well as at Kotak Mutual Fund. But at the same time, it's going to remain a hybrid system. We will serve our customers in physical world. We will serve our customers in digital world. And as you correctly mentioned, the world is going to go from physical to digital to physical.
Given the way AI, artificial intelligence, and machine learning has developed in the recent years, do you think a bot is going to be our future wealth manager?
Undoubtedly. If I read a balance sheet, I'll require probably 2.5 hours to go through a balance sheet. A machine will learn that balance sheet in probably 2.5 seconds. I will miss out many things while reading the balance sheet. Machine won't forget one digit. So there will be usage of artificial intelligence, machine learning, and data analytics in the business. Whether I use data analytics to figure out what product is appropriate for a customer, whether I use data analytics to figure out when am I going to receive redemptions, or whether I use machine learning to read balance sheets and make my research better. In every aspect of our business, we are going to see AI, ML coming together. And the same will be true on wealth management side. So we are undoubtedly going to use data and machine learning and AI to create better product and better services and better performance for our customers.
Right. So what advice would you give to someone looking to obtain wealth management services? What are the signs of how do you find out whether the wealth manager is skilled and ethical enough for you?
So there's no magic wand over here. If you want to, let's say, if you go to a new place and you want to eat out, how do you figure out whether this place is good enough or not? One, you will ask local contact, so you will get reference. You will go to Zomato, Swiggy kind of thing and figure out what is the rating of this restaurant. So you will go by digital opinion. And if you don't have access to physical reference or digital communication, you will probably go looking at the brand. If brand also is not available, you will still go there and look at the architecture, look at the restaurant, how good, bad it is, whether it's crowded or not. And finally, you will go there, place your order, taste it, and get yourself confirmation whether it's good enough or not. The same thing applies in wealth manager. Check the brand, check the references, check the servicing and digital solution aspect of the wealth manager. And the most importantly, experience it. When you start with the wealth manager, you don't start giving 100% of your wealth. You engage with him to figure out whether he or she has understood your risk return profile, whether he or she is doing transaction or he or she is offering you solution, whether he or she is interested in commission income or actually making you rich. So experience the wealth manager to finally reach a conclusion based on brand, digital connect, servicing, solutions, and experience whether this gentleman or woman is appropriate or not.
So can I sum it up by saying that wealth management is like a one-stop solution for getting all your queries, getting all your, how do you manage your own money, your taxes, your real estate, all your investment. It's like a one-stop solution. You don't have to run around different fund managers. You don't have to look for properties. You don't have to get separate income tax consultant, etc.
So undoubtedly, a full service wealth manager will be able to provide all these solutions packaged together. But many a times there are advisors who just give you the advice and then execution is done independently. So you choose a model which is appropriate to you. Do you need advice? You need advice plus execution. If you need advice, the costs are lower. If you need advice plus execution, costs are little higher. So there are different models available. One can choose whatever is convenient.
So, Mr. Shah, can you tell us how do we survive a bear market?
Well, in a bear market, what is the most exciting thing? In the bear market, most exciting thing is that you will be able to pick up stocks at much below fair value. And the money which you can make from a bear market to bull market will be the maximum. So think of this correction bear market as an opportunity to make more money. If there was no bear market, investors' return would have been far, far lower.
So if I have a watch list of stocks to buy, and put it on a watch list, and then how should I go about picking stocks in a bear market? Should I look at stocks that have proven to be more resilient or the ones that have fallen the most?
So in a bear market or a bull market or a range bond market, you have to buy that stocks which you believe are available at a discount to their fair value. Now, investment is an art, it's not a science. I may believe company X is available at 30% discount to fair value, and someone may believe that company X is actually trading at a 30% premium to fair value. If both of us will have same opinion, then how will the trade happen? Stock market is a place where seller thinks he is making money by selling and buyer thinks he is making money by buying. Then only the transactions will happen. So no matter what kind of market you are in, as long as you buy stocks which are representing good businesses, businesses where return on equity is more than cost of capital, run by good managers, managers who won't cheat you, who won't take you for a ride, and are available at good valuations where there is margin of safety involved. By and large, that becomes the good stock pick.
We have inflation, we know about inflation, we know about recession, we know about Fed rate hikes. Are all the devils known now?
See, it's like, cricket match. When you go to play cricket, you do know that a bouncer can come, a yorker can come, an off-swing can come, an in-swing can come. But at the end of the day, when you go on the pitch, who knows what will come? Same way in market, will have to be ready for whatever bowling throws at us. It is the nature of the market that it keeps on discounting various scenarios. So when there was no Russia-Ukraine situation, market didn't know where Ukraine was. The moment it became important, it started discounting it. So today, would market have taken into account higher oil prices, higher inflation, Russia-Ukraine geopolitical situation, US Fed rate movement, corporate profitability? Answer is undoubtedly yes. Market is collective wisdom of people. It invariably discounts all the known things. But there is always an unknown thing which comes and hits market, which we were not aware, which market was not aware.
Right. With Nifty below 16,000 level, do you think we are at a fair price?
So Nifty at about 16,000 level will be about 19 times forward earning post this windfall tax. So it looks like little above fair value, but still nearer to fair value compared to, let's say, in October 21. And This is the market where you will be equal weight to equity allocation based on your risk profile and time horizon and objective. And if market continues to correct, it could be time correction, because if 6 months down the line market is at same 16,000, it has become cheaper as earnings would have gone up. So there could be time correction, or there could be price correction. If 16,000 Nifty becomes 15,000, there is a price correction, or it could be both time and price correction. So in the correction phase of time, price, or both, keep on increasing your allocation to equity.
At a time when the interest rate cycle is changing, how do you think, how's the outlook change for banks?
Banks are generally the beneficiary of higher interest rate as their net interest margin expands. Obviously, there is a cost where higher interest rate does impact mark to market on their portfolio. But at this point of time, we believe benefits of rising interest rates on your net interest margin will be far more than the mark to market losses on your portfolio. More importantly, banks are having 10-year low NPS, and most of it is provided for. And then the final part is that there is consolidation happening in banking sector in terms of growth, where 2-3 public sector banks and 4-5 private sector banks are grabbing bulk of the credit growth. You have consolidation happening, you have a NIM expanding, and you have NPS provided for. I think all this put together creates huge opportunity for banking sector to outperform the market.
One last question, Mr. Shah. Which are the sectors that you're most bullish on at this stage?
Banking is one sector which I'm sure you would have picked up. The other sector which we are bullish is manufacturing. In 2014, India had about 3 or 4 mobile handset manufacturing factories, generating about 22,000 crore in revenue. We were net importer of mobile phones to the extent of $8 to $10 billion a year. Fast forward to 2022, we are the second largest manufacturer of mobile phones in the world. We produce more mobile phones than South Korea, Vietnam, US. Today, there is mobile production value of about 220,000 crore. India is now exporter of mobile phones, including iPhone 13, which is now made in India. What happened in mobile handset manufacturing can happen in other manufacturing areas. Indian manufacturing is becoming competitive because our labor cost is lower compared to the rest of the world. From infrastructure deficit, we will become infrastructure available. The government is also supporting creation of manufacturing setup. There are challenges in terms of logistics cost and power cost, but because of the advantages of labor cost and some other infrastructure availability, we are becoming competitive. China Plus One is also forcing large multinational companies to seek diversification out of China. The whole world is available to them, but few of them are coming to India. Put all these things together, India will become part of global supply chain management. Government is encouraging manufacturing in India. There is incentive scheme under production linked incentive scheme, which will make manufacturing in India more rewarding. And despite challenges of logistics and power, we are becoming competitive. What we did in mobile handsets will get replicated in many sectors, and collectively we call them manufacturing theme, where we are bullish.
That's all we have for now. Thank you, Mr. Shah, for giving us your valuable inputs and time.
Thank you.